It's December now, so I've decided that we're going to play some chill music for this month to help you chill and counteract all the stress of the holiday seasons. Welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm your host. And if you've not been here before, this is the show dedicated to helping you not just survive retirement, but to be intentional so you can rock retirement. Yeah, that sounds much better, doesn't it? So in December, we start to look at markets and our investments and start looking forward to 2019. And I'll tell you, in 2018, at least so far, international investing has been a real stinker. It's been a drag on a portfolio. So we're going to discuss today, is international diversification, having a slice of your asset allocation pie in international investments, is it worth it? And in our hot topic segment, we're going to review an article from Andrew Scott, co-author of one of my favorite books, The 100-Year Life. There's so much packed in there for people that are thinking about this later half in life. Great book. So we're going to review some of that, but we can't do any of those things until we have that all-important disclaimer. Someone asked me recently in an email, why don't you just put the disclaimer at the end? Well, we do have some legal disclaimer stuff at the end, but the reason I like to have this up front, because it's really important that you realize you can't take advice from me. And I'm not giving you any advice. I only give advice to clients that I work with. And it just makes sense because I don't know anything about you. I don't have enough information to give you advice, and you don't know that much about me. So I can give you some helpful hints in education. So I think this is all a good reminder. So before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Hey, before we get started with the show, I want to encourage you to go to rockretirementclub.com. This is a new private community of listeners from the show, people like you that are all dealing with the same issues, and they all have the same intentional spirit. And from talking to countless people, they're all very nice. This is a private community where we have quality conversations and help each other look for opportunities and look for risks that we can help manage together. We have worksheets to empower you to look at the blind spots and make sure you're covering all the bases. And we have quality education that we're building over time on how to manage cash flow in retirement, investing 101, asset allocation, how to evaluate a mutual fund or an investment strategy, education that we're building without a sales pitch at the end, which can be hard to find when you're looking for quality retirement education. So if you're into being intentional about rocking retirement and you've enjoyed the show, go to rockretirementclub.com because we'll be doing our public launch in January and you can get on the wait list. Now let's go learn about longevity. So in the news today, longevity is becoming a reality, not just for the younger folk, but for us baby boomers getting closer to retirement. So Andrew Scott, who he and a co-author wrote The 100-Year Life, he had an article recently that I found, and I'll have a link to it in our 6-Shot Saturday, which is our weekly friendly email every Saturday morning. You can sign up for that at rogerwhitney.com, and we'll have a link to this article. But he shared 10 facts about longevity that I thought would be good to review because it becomes a bigger issue, even if you're already near retirement. So this article is based off of UK data, so United Kingdom data. So we're going to use that. So I'll preface it with that. But he says, number one is we are all probably going to live longer than we think. And he says in the article, between 2001 and 2015, the chances of a man dying from heart disease declined by more than 50%, and the risk of dying from cancer also declined. He says the real big risk from longevity is that we're more likely to die from diseases such as dementia. He says the number of deaths from Alzheimer's increased threefold between 2001 and 2015. making it the leading cause of death in 2015. So, the boogeyman of heart disease and cancer, not that those aren't scary, dementia is becoming an even bigger issue. In fact, next week in our Hot Topic segment, we're going to highlight an article from a brain scientist on the things that he's doing to battle for himself dementia and Alzheimer's. So we're going to learn a little bit about what we can do, but that's an interesting fact. Another interesting fact about longevity is that centenarians are the fastest growing age group, and that's the number of people aged 100 and older. In 2015, there were about 451,000 I'm going to have to learn how to pronounce this word. Centenarians. There, I got it. And it's projected that that's going to reach over 3.6 million people in 2050. It's one of the fastest growing age groups. Interesting. The next fact is that it seems that about 120 years seems to be the natural limit currently. Jean Clement of France, who lived to be 122 years and 164 days old, passed away in 1997. That's the one verified oldest living person. The oldest person alive today is Violet Brown of Jamaica, who is 117 years old. But despite improvements of life expectancy over the last 20 years, it seems that this 120 number is the limit as of now. But I don't know if I'm encouraged or intimidated by the fact of genotherapy, artificial intelligence, all the things that are going on in research that, at some point it seems like that will push the limit. The next fact, which makes sense, is that there's been an inequality in lifespan increasing. According to Andrew Scott, in the U.S., based on about 1.4 billion tax records, suggests that the gap of life expectancy between the richest 1% and the poorest 1% is about 14 years for men, about 10 years for women. That's huge. And that's been widening since 1980. I imagine that has a lot to do with education background, access to health care, and more intentionality about taking care of yourself or having the money to do that. But that's a fact that I'm sure a lot of policy people are looking to address. Now, this next fact, which I think is an important one for baby boomers, is we are fitter and more productive for longer. The general perception of longevity, I know when I have conversations with clients, is, holy cow, I don't want to live a life where I can't do things. I can't be cognitively sharp or physically able to accomplish things. It's a scary thing. You think of decay a lot of times when we think of longevity and living to 100. That is the case, obviously, for some. But according to Andrew Scott, it's actually we're getting healthier and we're actually staying younger longer. And I think this ties into some of the conversations we've had and that I have with clients. And one reason why I think we need to redefine what retirement is, not a light switch, it's a dimmer switch of gaining more time freedom, but still doing something, some pretirement stage where we're dialing down full-time work, dialing up flexibility and time freedom, but we're still working. For the very fact that when we think of retirement like a light switch, we plan on stopping our life and going to the park bench, and we get there, you sit on the park bench and you realize, maybe I don't want to be on a park bench yet. I want to be out playing. And then sometimes you don't have as much flexibility to go back and earn an income and be active after you've just left your career thinking you were done. That's why I think the pretirement stage is so important. And I think these facts lead to it. And from a financial perspective, it allows you to combat probably one of the more underestimated changes when you leave full-time work is feeling totally without any control. You're not working, you're not making an income, you're drawing from your assets, you're dependent on pensions and market returns and interest rates in the economy, and you have very little flexibility to pivot or improve the situation if things happen to go wrong. Whereas if you're in pretirement and you're working a little bit, you have some control to help mitigate issues and improve the situation. So mentally, you feel a lot more confident in managing your life than when you're fully retired, because now you're retired, right? You're at the whim of outside forces much more. And a few more facts I won't really go into. Marriage is happening later and later. People want to be with people, which makes sense about community, and it is more likely that a woman in their 40s will have a child than a woman aged less than 20, which is an interesting fact if you think about it. He says in his fact number 10, the divorce rate is falling overall, but it's rising for those aged over 50. That's important. You want to blow up your financial life, and we talked about this. Get divorced over 50 and divide everything up and have to establish two separate households. Talk about a financial mess and a personal mess in terms of your social network. You're not just blowing up your financial life in some ways. You're blowing up your social network, which is key to happiness. One reason why it's important to invest in your relationships and in your health and be really intentional about that. We think that's all soft stuff. Okay, I'm going to talk here for a second. We think that's all soft stuff. There are direct financial impacts to investing in your health and investing in your relationships that we totally underestimate. That can, if you do it intentionally, they can save you from financial disaster and they can make your life a lot happier. That's more important to talk about than, well, really, whether we should have international allocation or not. We still got to deal with those tactical things, but this stuff is really where the power is. So I'll have a link to that in 6 Shot Saturday. You can sign up for that email list at rogerwhitney.com. But let's go talk about some of this tactical stuff and international diversification. About a month or so ago, I was at FinCon, which is a geeky finance conference, lots of fun. And David Stein of the show Money for the Rest of Us hung out a lot, and we had some conversations and had dinner with his wife and he, and really just geeked out and had fun together. He's a great guy, great show, Money for the Rest of Us. Check it out. And we were talking about international diversification. And I'm going to play a little bit of that conversation because, we're podcasters, we tape things. But before I do that, let's set the stage a little bit. As an advisor, I've heard for probably 20 years the case for having a portion of your portfolio in international equities. So what we're talking about is for your equity portion, your stocks, to have anywhere from 10 to 30% of your equity portfolio in international stocks. In stocks in China, in Europe, and in Russia, and France, and the UK, all over the place. And the logic has always been that it will give you increased diversification, right? Because you're investing in different economies, in different currencies, in different markets, which should help broaden your diversification, which is a way of spreading risk. And that there are a lot of companies, amazing companies, that are not domiciled in the United States. Great companies like BMW, Volkswagen, Nestle, Royal Dutch Shell, Toyota, SAP, some amazing companies that are not domiciled in the United States. And if you only have a domestic equity portfolio, you're not going to own just a great company. So it gives managers or strategies a broader set of amazing companies to choose from, whether it's in an index-based portfolio or in an active management portfolio. So it's a good case. And then another case has been, or other things they say is, well, it's not perfectly correlated, meaning that they may zig when the United States markets zag, which can help manage risk. These are some of the cases for having exposure to international equities. Now, what's the case against international equities? Well, it can be more expensive to own, right? Because you have complications of, if it's an active manager, they got to do research on companies in different languages with different accounting standards, etc. You have exchange rates because international companies trade in different currencies and those can greatly impact returns. So you have to manage that. You got to go buy things on different exchanges. And even in an index-based portfolio, you still have some of those complications. So index-based portfolios tend to have a higher cost structure than something that's mimicking the S&P 500. You could argue there's not as much of a diversification benefit as there used to be, because as we've gotten more global economy rather than these domestic economies that trade together, a lot of times every boat is going up and down together. In fact, we'll talk about that when we look at some stats with international investing. So there's that fallacy of diversification in that really all these markets move together. And they can be less tax efficient because of some of the things that I talked about. So those are some of the cases against it. But let's just dive into some stats about international investing, and then we'll play the chat with David, and you can make a decision for yourself. So let's look at some performance or some statistics around international investing. So what we're going to do is we're going to look at an index. And you can't invest in an index. You can only invest in things that mimic an index. And so the index we're going to use is the MSCI-EAFE, EAFE index. This is one of the major benchmarks that tracks developed international markets, meaning more mature economies, not the emerging markets, the Brazils and the smaller countries that are coming up. So we're going to use data mimicking from this index, and I pulled most of this from Morningstar. So let's first look at returns. So in 2018, as of November 6, the international index was down over 8.25%. In fact, at periods of time, I believe we saw it down almost negative 13%. That was while the U.S. economy, the S&P 500, was really doing well. So it's been sort of a stinker year for international investing. If you've had a global portfolio or a portfolio that had a slice to international, you're losing money this year, whilst other things have been making money. Not as of late because we've had this big, correction, and we'll see how the rest of the year goes. But international has been sort of stinky. Now, last year, international index did about what the S&P 500 did, over 20%. But if we look at a 3-year average return for the international index, it's about 9.23% annualized over the last 3 years. Mainly a big one last year really helped the index because if we look at the 5-year average, it's been about 4.4% per year in the international markets, whereas the S&P 500 index over the last 3 years has been about 12.5%. So that's a big difference. Definitely was a drag on performance relative to the U.S. over 3 years, over 5 years. And if we look at a 10-year average, the MSCI-EAFE index had an average return over the last 10 years, according to Morningstar, of 5.38% per year, relative to the S&P 500, which has had a 10-year average about just over 14% a year in 100% in U.S. equities. And then just to round it out, over the last 15 years, the MSCI-EAFE index has been about 5.78% per year. And over the last 15 years, the S&P 500, about 9%. So if you have been an international investor or have had a good portion of your assets, equity assets in international investing, it's dragged performance down. You would have been better off just being 100% in the U.S. Now, some could argue that, hey, we've had an amazing run on the U.S. dollar, and when the U.S. dollar goes up, that's a big headwind for international stocks. We've had Brexit, all the stuff going on in Britain and the European Union. We just came out of all the issues that Greece has. There's lots of explanations we can apply to this. And really, over the last 10 years, the U.S. has been the place from a business standpoint, from an economy standpoint, and from a market standpoint. U.S. equities have been the place. So it's easy to say, well, why would I go do that? Especially if we look at risk characteristics. So over the last 15 years, the standard deviation for this international index, so standard deviation is the variability of return. So I always use the weather example of the weather, the average temperature in Texas is about the same as the average temperature in San Diego, Dallas-Fort Worth to San Diego. It's about, in the mid-70s. But in Dallas, the temperature can be 100 and it can be 20. In San Diego, if the average temperature is in the 70s, it can be 90 or it can be maybe 50. So Dallas-Fort Worth, even though the average is about the same, it can have this huge swing in possible outcomes on a short-term basis. That's what standard deviation basically is. So the standard deviation for the international index is about 16.3, and for the S&P, about 13.4. So it means that international indexes are a little bit more volatile around its average, or can be. In portfolio construction, that's risk. And then, so it's more risky, we'll call it, than U.S. stocks, and it's performed less over the last 10 to 15 years. And then the correlation, the 10-year correlation. So what's correlation? Correlation are how two things move together. So a correlation of 1 means if the international index goes up by 1, the U.S. market goes up by 1. A correlation of -1 is a perfectly uncorrelated asset, meaning that they go exactly in opposite directions like a seesaw or a teeter-totter. You don't really find things that are perfectly correlated. You don't find things that are perfectly uncorrelated. Usually it's somewhere in the middle. So over the last 10 years, international markets have had a 0.9% correlation to the U.S. markets, meaning that if the U.S. market went up by $1, international markets statistically went up by 90 cents and vice versa. That's a high correlation. So when you're thinking of diversification, you're trying to get assets that have different correlations so they can help balance things out as one thing zigging, the other thing zagging, and as a whole, you have a more stable return sequence. That makes sense? So wow, we have less returns. Pretty much they move together. And then when we've had major upheavals in the world or in the markets, '08, things usually become, equities especially, become very perfectly correlated. I mean, they all go to 1 really quickly. And we saw that in '08, which was really a worldwide crisis. So unless the little epidemic is localized, a lot of times equities will get very correlated and move together in times of real stress. So some of the argument goes is, well, even if they're not very correlated, when in times of stress they become highly correlated, well, that's when you need the non-correlation the most, and it doesn't give it to you a lot of times. Wow, just talking through these statistics, I'm talking myself out of it. So here are my thoughts, and then we'll go to our conversation with David as I think through this, because I am a global investor. I tend to have allocations that are looking at the entire world to choose from an equity perspective. Even though it's still U.S.-centric, I still believe that you want to be globally invested. And one, you got to be very careful about making decisions looking backwards in time because things are typically cyclical over time. And unless you're investing for shorter periods of time, you want to have enough diversification so as things go through their cycle, you end up with a better outcome or a potential for a better outcome. Many times psychologically, and we've seen it in mutual fund flow data, which measures where people are putting their money and where they're taking their money out of. We've seen it time and time again that typically people are selling all the things that just did bad or have done poorly, and they're buying the things that have done extremely well. Because mentally we play this trick on ourselves that we think we get the performance from history. Just like if we buy a washer, we get, the features that are listed on the sales tag. Well, it doesn't work that way. And a lot of times what ends up happening is we sell the things that are bad right when all the damage is done. And we buy the things that are good when everything awesome is priced in, and then slowly the cycles revert and go back. And we end up making bad behavioral decisions. So I am personally a believer in global investing. I think you want to have a U.S.-centric based a little bit. We have roughly 20-ish%, I think, of our portfolios on average in international. I mean, that's going to vary, obviously, but I'm a big international investor. I still think it's a worthy place to be. And so let's chat with David and get an idea of what he thinks.
So I have a question for you. Everybody says to be globally diversified, and international stocks have been horrible, it seems like, for almost 10 years now. Is there really value to be diversified internationally, or should we just be more traditionally U.S.-centric?
Well, it had been horrible for 10 years. Non-U.S. outperformed last year by a significant margin. Emerging markets are up over 30%. But it comes down to why are U.S. stocks outperforming? Are they outperforming because they're growing faster in terms of their earnings? Or are their dividend yields higher? Because you have to look at what drives it. Or are they getting more expensive? And when you look at the last 10 years, U.S. stocks have gotten more expensive than non-U.S. stocks. And that's what's driven the outperformance. The dividend yield's lower, so it's not the income. Mm-hmm. Now, in the last year, with the tax cut, corporate profits have been double digits, almost 20% for U.S. stocks. So you do have profit aspect, but the primary thing has been you have U.S. stocks selling for price to earnings ratio over 20. Non-U.S. is much, far below 20. And so that's the driver. And so then the question is going forward, will U.S. companies grow faster than non-U.S. or will the valuations fall? And I have both. I think most people should have both. I think 56% of the world is U.S. If you have more than 56% of your stock portfolio in U.S., then you're overweight. And so then you have to question, why am I overweight? Is that justified? And some people say yes, others no.
Yeah, and I agree. And it's not really about predicting which one's going to work and which one's not. It's just you have more diversification, and which means the negative diversification on the short term is one is going to seem much better than the other, and you're going to feel like you're always being left out in some way. If you're globally diversified over the last number of years, you sort of feel like you're getting dragged down rather than participating.
Well, you are. And diversification is something's always underperforming if you're diversified. But the issue is, if you are globally diversified, you want to own the world.
Right.
And so you want to own the world in the world's percentage. You want to own the market, and the market is 56% US. And so to the extent that this idea that, and even if you're in an index fund, could people say, well, I'm passive investing. Yes, you're passive investing, but as soon as you have most of your stock exposure in US, that's not a passive bet. That is an active allocation bet to be significantly overweight the US. And as long as people realize that.
Well, even the people that advocate being globally diversified equity-wise, they say, well, you should have a 15% allocation to international stocks to complement U.S. stocks. But to your point, if it's 44% international, it should be, if you truly want to be globally diversified and believe in global companies and everybody's participating, you should have the world much more than people typically do, even the ones that advocate for international.
Oh, right. And because people, they have home country bias, they're more comfortable. I mean, think about if you're a Canadian investor. Canada makes up 3% of the world population. So should Canadians only have 90% of their stocks in Canada because they live in Canada? No, most Canadians have far more outside of Canada because Canada is such a small part. And Canada's stock market is very much dependent on resources, oil, energy, and things like that. And so they're diversified.
Yeah.
But the U.S., we tend to think, well, U.S. is the biggest economy in the world, so that's all I need. And I disagree with that.
Hey, welcome to the Happy Lab, where we noodle on how to be happy. Nicole, what do you think about maybe living to 105? Is that going to make you happy?
I don't know, actually. That's kind of a tricky question. Do I still have friends and family around? It could be kind of lonely.
That is a really good point. If longevity is a serious issue for everybody, I think of my grandma this way, because she died in her mid-90s. And she got lonelier and lonelier after 2 husbands passed, sisters, friends, brothers. She was sort of the last person standing. So that's a really good, if you're going to live a long time, we're going to have to make sure to be happy. We're going to have to make sure we're reinvesting in relationships and building healthy relationships, maybe with some people younger than us. So we're not the last person standing.
Yeah.
Right?
That's a fair point.
Right. That's why I talk to you.
So I can be your person when you're 105.
You and Clay are going to take care of me when I move into your house when I'm 95. So be prepared. And go make sure you're making younger friends, because that'll make us happy as we get older. You can't fear it because you can't do anything about it, so you might as well lean into it. All right, let's go set a smart sprint.
On your marks, get set.
And we're off to set a 7-day sprint to take a little baby step to intentionally create a great life. So we're talking about international investing today. And is it even worth it? So my action step for you is to go review your asset allocation, identify how much exposure you have to international markets or global markets, and make a decision of what you want that to be for 2019. Given some of the stuff that we talked about today and other research you can do. All right, get to it. All right, now we're in the middle of the holiday season. So remember, we don't just want to rock retirement. We want to rock the holidays, and you got to be intentional about it. So take care of yourself. Don't get too stressed out, and enjoy your family and friends. I enjoy you, Nicole.
I enjoy you too, Roger.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.